Hi, welcome back. You're with MF Corner. We're now joined by Kushal Bhagi, co-founder of Tortica Wealth Managers. Hi, Kushal. Good afternoon. And today what we're discussing is what are the future sources of alpha generation. But first, I want to begin by asking you, how easy or difficult is it for an investor to actually just make market returns? And why aren't more investors making it?
Hi, thanks, Samara, and good afternoon to all your viewers. And that's a good place to start. If you look at just the market returns, and I'm going to define market returns as the Nifty, it over the last 10 years and 20 years has given you a CAGR of 13 and 15%. Right now, that's an insane amount of money when compounded. So all you have to do is remain invested for the period of 10 years, 15 years, 20 years, and there is wealth to be created. But like we know, most investors haven't been able to do so, right? And because that is, once you start investing, you realize that it's emotionally really hard to remain 100% invested all the time. The one thing that people don't like to do is they don't like to lose money. And if you are going to be invested over a period of time, you are going to lose money from time to time. And at times, you're going to lose massive amounts. So, what we've typically seen happens, and this is just human emotion, no matter where you are in the world, when you can't see the bloodshed anymore, when you can't see the market destroy your wealth further, your investment approach can be pretty haphazard because you're buying at the wrong time, you're selling at the wrong time. And as a result, you do land up earning lesser returns than the underlying fund itself. So you're right, achieving market returns over a long period of time is no easy job. It's a feat in itself. And a pat on the back for those investors who have been able to do it, because spending time in the market is the most amazing skill set to possess in the world of investing.
No, fair enough, Kushal. But even if I was to say remain invested, but I remain invested in say an actively managed fund which does not create alpha. You know, I mean, is this how will this alpha be created? I mean, you have to resort to stock picking to generate returns higher than benchmarks. I mean, is this going to be a source of continued alpha or not?
So let me approach this from a slightly different angle than usual, right? And I'm going to base my point of view on an empirical observation that throughout history, there are few stocks that have contributed disproportionately to the rise of markets and index. Is that something you can agree with me on as an observation?
Why not?
Right. So, the point is that if there are few stocks which are driving the performance of an index upwards disproportionately, if as a stock picker or a fund manager, you haven't picked these stocks, so you've picked these stocks with lesser weightage, then the underperformance is definitely going to be there, right? Now, let me give you an illustration, if I may, with just some numbers, right? Let's assume there are only 5 stocks in the universe, and 10 of them give, and 4 of them rather, give you a 10% return, and one of them give you a 50% return. Now, you don't know which is going to give you what beforehand, obviously. And if you had an opportunity to create 1 stock or 2 stock portfolios, right, that means essentially you are able to create 15 portfolios. And if you are able to create 15 portfolios, the overall market return, which is 10 plus 10 plus 10 plus 10 plus 50, comes to 18%. But if you are doing 1 stock and 2 stock portfolios, only 5 of these portfolios are going to beat the market, right? 2/3 of these portfolios are actually going to underperform. And so, when you talk about actively managed funds, the usual talk is that because they have an higher expense ratio, they're that much more on the back foot. But we actually sit down and start wondering, is there a more structural reason for underperformance across the board? Because if you look at it in the US as well, right, over the last 15 years and 20 years, which are great time frames to look at equity investing, 8 out of every 10 actively managed funds has underperformed the benchmark. And therefore, you're seeing sort of a global rise in passive investing across the board, right? Now, of course, when you look at home, when you look at India, people may have a different point of view. People may say, yahan to alpha milta hai, right? But again, if you look at the data and if you see what SEBI has done in the last 3 or 4 years that is affecting this big picture, A, with regards to performance reporting, and B, with regards to the reclassification of schemes, which essentially in effect straitjackets a lot of mutual funds, right? Because they define the universe that they can invest in. So I think it's common consensus that in large cap mutual funds, for example, alpha generation or picking a consistent winner in advance is going to be really hard and going to get harder getting forward. 9 out of every 10 funds, or 8.5 out of every 10 funds have been underperforming the index any which ways. So then where do you look for alpha? Do you look at mid caps? Do you look at focused funds. And again, in mid caps, I think in the last 10 years, what, 5 out of every 10 mid caps has underperformed. If you look at focused funds, it means that you are selecting fewer stocks. And again, if you are selecting fewer stocks, statistically, the chances of underperformance are greater than the chances of outperformance. So, before we dive in, I just want to say to your viewers that if you are going to create alpha and significant alpha, you have to do something that is very different from what the market is doing. And while that's great if it's working and when it's working, there are definitely going to be periods when you're underperforming as well. So, the question begs, do fund managers even want to face that kind of scrutiny, and will investors actually live with this underperformance? And that's an interesting, debatable topic in its own.
So, Kushal, then are there any sources where, MF investors can sort of hope to have alpha generation going forward?
Sure, and I don't mean to say that in flexi-cap, mid-cap, etc., you're not going to get alpha. I'm just saying it's going to be harder to identify in advance where you're going to get that alpha, okay? So with that disclaimer, I think I'd like to talk about 3 areas where the MF industry can generate alpha, and the first is thematic funds. Now, thematic funds have largely been an opportunistic play. So the question remains, when is the right time to get in, and how sustainable is that theme or that edge going to be, okay? So let's talk about, a flavor of the times, which is ESG, which is your environmentally, social, and governance factors, which one looks at. And post the global financial crisis, this has really sort of taken center stage in some sense. And the last 10 years, they've generated a lot of alpha globally. But you also have another point of view, and that other point of view is saying that, is ESG really contributing that much to this outperformance, or is there momentum in the market which has taken these stocks ahead any which ways? Is there really a significant overlap that a lot of these ESG stocks would have been quality stocks that you picked in your portfolio any which ways? Now, the answer to these kind of questions, only time is going to tell, right? Does ESG stick on and investors' love for ESG continue over a period of time, or is performance going to revert to normal? So that question is going to remain, and that's the risk that you take when you look at thematic funds. Right? The other point is when you're looking at diversifying globally, like, India has a pretty small global market share, right? So if you are going to look outside India, the lure of investing in disruptive companies who won't want to own a Facebook or an Apple or a Google, these companies that offer lucrative returns, or even invest in emerging economies that offer promising performance. And then there's obviously a part which a lot of investors may not really understand or appreciate properly, which is the currency play, which can go for you or against you depending on how the rupee behaves. So there is a bit of uncertainty because people don't understand global markets as well as they understand domestic markets. But what has changed is the access to such investments and opportunities. And you have a slew of funds that have come into India as well. And people and investors have started allocating a small percentage of their fund to such kind of exposures, right? So these are 2, and the last one is what I call a smart beta or quant or rule-based investing processes. And this, Samara, the last 5 to 7 years has been growing even faster than ETFs and index funds worldwide.
No, I take your point entirely because there is a lot of interest in smart beta, but I'm not sure if it's entirely been understood by retail investors in India. What exactly is the edge that this quant or smart beta offers?
Okay, so as the name suggests, and we've been using these words synonymously, so let's just stick with rule-based investing for this conversation, right? It's nothing but a different style of investing, and it's a style of investing that looks at data and that invests with a set of rules or a model where the decision-making process is free from any human bias, which is fund manager human bias and fund manager discretion. Now, these rule-based investing can be used in 2 ways primarily, right? And one is in construction of a portfolio where you have a set of filters which you've identified, you have a universe of stocks, you eliminate stocks, and then you select stocks. So it can be argued that, is this any different to rigorous processes that AMCs and fund managers have in the first place? Probably not. It's just, like I said, it's adding a little bit more rigor, and it is completely rule-based. So it takes that human element out of the equation. And the other purpose where you can use quant or rule-based investing is for the purposes of asset allocation. And asset allocation is one of the prime driver of investment returns or investor returns. So when you talk about asset allocation, and this is an area quite dear to me, it is the fact that you're saying that equity risk is different at different levels of valuation. So you must adjust equity exposure in response to large shifts of valuation. Now, you've got in India DAF funds and your dynamic asset allocation, which is probably a better word. These are a great category of funds. Unfortunately, they've been missold in the past. But I think they're finding their feet again as valuations have gone towards such high levels. But the narrative now for most of the funds is and should be very clear that these funds focus on reducing volatility. Now, we're going to focus on reducing volatility, and that is the message that is getting across to the investor. Are you going to be able to create alpha? No, you're not going to be able to create alpha. Are you going to be able to create inflation plus returns? Yes, there's a high probability of being able to do that. So the idea is that if people and investors have not demonstrated that they can remain invested in pure equity funds for long periods because it's emotionally very hard to do so, can you, by giving a less volatile experience, solve that problem? Okay. So where can you use asset allocation to create an alpha? And then if you have to do it, you have to be more extreme about it, which is to say, when you're bullish in the market, you should be 100% invested in the market. When you're defensive about it, you have to aggressively take defensive bets. So as I mentioned earlier, whenever you are searching for alpha, you run the risk of underperformance as well. But I suspect that when you are talking about asset allocation, it pays to be a little aggressive because, this behavioral edge, which is the cycle of greed and fear, has existed since millennia, and it's going to continue to sustain for longer periods of time. At least, in my mind, it's going to sustain longer than the other options that we've mentioned so far.
All right, Kushal, thanks very much for joining in. We're out of time, but not out of ideas after speaking with you, so thanks very much. So, once again, while we can blame fund managers for not, doing enough active work to generate alpha, the point to also remember is that you have to remain invested and not allow your own behavioral biases to come into play. All right, thanks very much for watching MF Corner. Do keep sending us all your queries, and we'll try and address most of them through our experts through the week. Stay tuned. Closing Bell will join you next.